Welcome back, everybody, to this episode of Hamilton Icons. I am your host and local real estate agent, Justin Little. Today, I am joined by an incredibly exciting guest. But before we get into that, I want to take this opportunity to tell you to pick up a copy of my book, The Sold Formula, How to Sell for More in Any Market. It just came in. If you want a free copy, reach out, save some money. And it's got all the tips and tricks in there for getting your house listed for sale and having a smooth and seamless process. Now, let's jump in to this episode. Today, I am joined by Kyle Cole, who is a mortgage specialist with BMO. Kyle, thank you so much for joining us.
No, thank you for having me. Really appreciate it.
Yeah, it's putting this together. I'm always excited to have people from a bank on because I find that the banks always have really cool programs going on. There's always different things that can happen. And, you know, some people, they prefer to work with their bank, right? So if you're an existing BMO client, it's always good to kind of freshen up on what's going on there. So before we dive into that, why don't you tell us a little bit about yourself? Like what led you to becoming a mortgage specialist with BMO?
Yeah, it's a very interesting path to say the least. So funny enough, in university, wasn't sure of what I wanted to do. I took the science route, ended up getting a degree in kinesiology, so the study of the human body. So taking a 360-degree turn and going into finance from there. I started a frontline role with the contact center as my first full-time position straight out of university. Made my way through the contact center, through branches, and now as a more mobile mortgage specialist. So doing mortgages for about 7 years now in multiple different roles. I finally found my niche and happy to be here.
That's awesome. That's quite the switch. From kinesiology to finance, it's like a night and day switch. What made you make that decision?
Honestly, a best friend of mine, same thing. He went and finished university and was like, okay, well, I want to see what I want to do. He did poli-sci, so it was kind of same thing for him. And we just kind of started at the bank together and made our way through together as kind of a team in a way, working in multiple different roles together, sprouting and growing our careers at such a young age.
Nice. And still growing. I mean, it's an exciting career. I feel like over the last few years, especially just with everything going on in the world and, you know, mortgages and rates and everything, I feel like the society's never been so in tune with rates. I don't know. It's just me, but everybody knows like when the announcement is.
Yep. Everyone. People even with no financial background. The good thing about technology is information is at your fingertips. So you can get a lot of information just by quickly using Google, ChatGPT. The amount of times people say, oh, I spoke to ChatGPT and asked about rates and options, and they gave me a full list of what I should do. And a lot of the times it can be correct, yes, but you don't get that human touch. You don't get that human aspect of, you know, technology might think that one thing is the best for you. However, experience from a human mind can go a long way as well.
Mm-hmm. Yeah, especially when you have the human mind, you're aware of the processes that you need to, like you're in it every day. So you can help guidance based on the personal situation, right? Like even I used ChatGPT when I was doing a challenge like with my gym and I had to diet. So I used it to come up with a meal plan, but then I realized like it wasn't dialing in on certain things after talking to somebody that did nutrition. And then I was like, okay, so I had to like make the adjustment, right? So like AI is good. I find like it's great for information. Obviously it's going to get a lot better over time, but I feel like you're always going to need that human element too, especially when it comes to mortgages, just because of the intricacies involved with it, right?
100%. There's so many different things that can cause a mortgage process to go wrong. And that's where we come in and we want to make sure that it's a smooth, quick process for any client who has any questions.
Mm-hmm. Yeah. And so let's go through some of the BMO specific programs because I'm always interested in what banks are doing and how we can use these programs to best benefit our clients when they're purchasing or refinancing or whatever it may be. Like what are some of the popular programs that you guys are running right now?
Yeah, a lot of the biggest one, and it's specifically due to COVID. What we noticed is sadly during the COVID times, a lot of people got laid off. Their full-time position wasn't always secure, so they started doing their own ventures. And by own ventures, I mean sole proprietorship, owning a corporation, so basically becoming self-employed. So BMO really stepped up in that space where we want to be able to help the self-employed. Although from a financial standpoint, and you can probably talk about this yourself, being self-employed, there's a lot of different ways that accountants use strategies for clients who are self-employed to not show a lot of income, because then they cannot pay a lot of taxes. Completely legal. It just from a financial standpoint, you show a lot less income, pay a lot less taxes. So we can sometimes use this to our benefit based on the client's situation. So the biggest one is clients who own a corporation, who, their business might make, call it $100,000. However, on paper, they only show $50,000. We can actually use their business financials to help increase their income on paper to help them get approved for more. That's why you always hear where the self-employed clients, a lot of the times they have to go through brokers, B lenders, even sometimes C lenders or private, because they don't show a lot of income. And of course, the banks don't like that, sadly. But with this program, we can really take I like to call it a common sense approach to help understand their situation a lot deeper when it comes to their business financials, to help pull some hypothetical income to get you approved for a lot more.
And that's a interesting program, because you're right, self-employed, it's very difficult to get financing, right? And I know for the first 2 years, I couldn't even get anything because, because
especially now with the banks, sadly.
Yeah.
That's just the way they operate.
And then, but I see a lot of people go through it too, like people that might operate in cash spaces, right? They don't show it. Like you said, they're trying to be tax efficient. So like, oh, I'm going to take some cash. I won't pay taxes. But when they turn around and it looks like they made no money last year, it becomes very difficult, right? So do you guys, I guess you take into consideration what, like business expenses?
Good question. There's 3 main buckets that we take a look at. The first one being you need a 2-year history. We need a 2-year average to show the financials are clean and I guess growing in a way. We take a look at what's called the asset to liability ratio. We want to make sure that you have more assets within your business than liabilities at a 1.1 to 1 ratio. So what that looks like in numbers, hypothetically, just say you have $1.1 million in assets, you cannot have more than $1 million in liabilities. So it's a ratio driven calculation. Along with that, we want to see the business growth, so that it is consistent on that 2-year history in the 2-year average. And then the last thing is it depends on how much income that you specifically claim compared to your business. So if a business is making, $500,000 a year consistently, however, you're only showing 35, 40, 50,000, we might not be able to use the full amount. And that's where speak with me at Bank of Montreal and we can kind of figure out the numbers on paper beforehand.
Okay. So, and if you're this, like, let's say the sole owner of your business, would it be easier to use the business income versus if you had like partners in the business?
So that's where it becomes even trickier. And that's why this program it's very unique. So there's a lot of different details included in this. Another one being that I forgot to mention, you do have to be the sole owner of the business. So anyone on the application, you have to be in the business and owner, or at least 50% owner in order to utilize a specific amount of the percentage of the income. This is where it gets very complicated if you're in a venture with 4 different directors and it's all 25%. Then the program might not work out well for you specific, but it's more so guided to those who own the business themselves. Sometimes even maybe their spouse is on the business too. That way we can use the full amount.
Mm-hmm. And that's why I think it's always important. Like people try, obviously you want to lower your taxable income as much as possible, right? Like that's always the goal for it. But even me personally, like I feel I don't have an issue paying taxes because I know that I want that lending power. I know that I'm going to have to qualify for stuff down the road. So I always take into consideration like, okay, I'm not going to push anything here. I just want to do it and still show a decent business income and personal income, right? Because I still do like to qualify for stuff like financing laws. Even if you go to get like a car and stuff, I feel like it could affect you, right?
100%.
If you're not showing income and stuff like that.
And I always tell self-employed clients of mine is if they do kind of come back and rebuttal and say, oh, well, my income is in the business and I just choose to do this because it's a lot less taxes. It's like, yes, perfect. But sadly, you can't have it both ways. You can never have it both ways, especially when you're dealing with a bank sometimes.
How do you deal with people that are like mainly cash businesses? Like say a tow truck driver or something, or a pizzeria owner? Or...
Honestly, the short answer is we can't. We can't. And it comes down to claimed income. That's the be all end all, especially when it comes to the bank's financing. And that's why you'll notice clients like that, generally speaking, 90% plus of the time they have to go private, C lender, anything like that, where then their rate is much higher. They have a lot more loan to value discrepancies where you might, instead of putting 20%, you need 30, 35, 40. So that's where it gets very, very tricky when it comes to financing.
That makes sense. Yeah, you want, I guess so. It's the income on paper, which is important, right?
Which is great. You're getting cash for your business. That's great. However, like mentioned, you can't have it both ways, sadly.
Yeah, and it goes even beyond that in a lot of fields. Like when we're renting properties out, when we're qualifying tenants, and they work something, they say, "Oh, but I make this much in cash." Well, we don't know that, right? You could just be saying it. So I completely understand.
That's the best way to put it too. You can't prove it.
Yeah,
you can't necessarily prove it, especially when it's in cash.
Yeah, so that's a good program to know about. What else are you guys running over there?
We have a high net worth savers advantage program is what we call it. So it's more so guided to clients that they might not necessarily have that full income. However, they have strong investments. Where we see this is with a lot of clients that might have funds that were passed down through estates, older clients who are retired where they only have the pension income, but they have a whole load of assets, whether it's in their RSPs or RIFs, TFSAs, non-registered, anything like that. We basically have a program where we take a look at your holistic approach, and we take a look at your total income, and then we compare it to how much you can get approved for. So hypothetically speaking, I'm a numbers guy, so it's a lot easier to kind of jump into numbers. Hypothetically, just say 2 clients based off of their pension incomes and whatnot, they can get approved for, call it $300,000 of a mortgage. If they can show that they have an additional, call it $500,000 in liquid assets, where RSPs, TFSAs, non-registered investments for at least 1 year, we can actually get them approved for that extra 500 more, so up to 800,000. So it's utilizing the approach of, hypothetically, if something was to go south, the clients could pull their investments. Of course, that's not the goal, but it's from the bank's perspective of they could pull from their investments in full and pay off that mortgage, and then they can now service the remainder amount. The best part about this program is I like to call it, we take indirect leverage. So we don't actually need to bring over the investments to BMO. We don't need to put a hold on the investments. We just need to show that consistency of 1 year of those investments being there, and we're able to get you approved for that increased amount.
Those are a lot of really good points, because my first point would say, okay, well then do I have to move stuff to BMO? But you don't. So that's good to know, right? And I think that's a lot of things people don't know is the ability to leverage these investments. They spend all their life or, a certain period of time maxing out the TFSA, maxing out the RSP. And then you think, okay, it's just sitting there, and you think you have to take it out if you want to do something, but you don't even think that you can use it as collateral, right? Like you can leverage it for financing.
Absolutely. And that's why it's indirect leverage. That's the best part about it, is we don't need to touch it. We just need to show it's there for consistency. And that's the biggest part of the program that I do love.
Nice. Who do you see mostly utilizing that type of program?
Honestly, the 2 examples I gave, so older individuals, seniors, who might want to, they're getting closer or they're in their retirement stage, but they do still want to qualify for a little bit of a mortgage. They have strong financial planning backgrounds, or they work strongly with a financial planner where their portfolio is growing and they're able to pull that extra dollar amount to help pay for a potential mortgage. So utilizing that strategy for older clients is the biggest one. And then honestly, those estate clients where they got some inheritance, and they've kept it and held it for a long period of time, and they don't know what to do with it. And, they want to get approved for a mortgage. However, sometimes, especially in this market and economy, you generally need 2 strong incomes to get approved. So utilizing that as well. So the estate clients.
That makes sense, because what's surprising is how many people I do see that are seniors that do take on mortgages. And where I see it the most is people that, to give Hamilton specifically as an example, what I see a lot is people want to go into these bungalow communities that are bungalow townhouses, right? But the problem is those prices are sometimes equal to, or if not higher than the home that they lived on East 23rd Street for like 60 years, right?
Right.
When they go to sell that, they might sell that for, my all original pink carpets, whatever it may be, $650, and then they're going and trying to buy something, but they're paying $650, $700, $750 on the other end. So they actually do need to take some sort of mortgage or a loan to bridge that, right? And that's who you're right. Now that you mention it, because I had a client do it last year, right? And then it was even then, I remember when I brought it up even to my mom, and She said they always tried to get into bigger homes. They always tried to move up because she said in her mind, she was always watching what those retirement areas were selling for. So she's like, I need to get into a house that I can actually come down from.
Right.
So that's kind of how she planned it.
And you notice there's always a premium on those types of properties because they know people will pay for them. Because it's a niche, right?
The number 2 hottest area in Hamilton is that part near Garth and 20 Road. There's about 3 communities, 4 if you include St. Elizabeth Village. They have the highest amount of sales year to date so far, the most number of sales. So it is a hot one. The first hottest, in case people are wondering, is Crown Point, which is Ottawa Street North. So if you have a house in Crown Point, now is the time to sell it because they are going like crazy over there. 1 out of 3 is selling in competition. That's crazy.
Location and the type of property can make a huge difference, especially in a market like this.
Yeah, because then you go to other areas of Hamilton and it could sit for 3 months, 4 months, right?
And we're seeing it all the time. Not even just Hamilton, everywhere. A lot of the GTA as well.
Yeah.
Property sitting.
Yeah. And do you deal with a lot of bridge loans?
Yes, absolutely.
Can you explain what a bridge loan is?
100%. So basically a bridge loan in essence is when you purchase a property and we can use dates for a good example. Just say you purchase a property and it's closing the new purchase on, call it June 30th. However, the funds from your current residence are going to be needed for either it's the down payment, closing costs, a mix of both for your new property. However, your home doesn't sell until July 14th. Now, what the bank provides is, in that case, you'll need a 2-week bridge in order to bridge the gap, quote unquote, of the funds that you would be getting from your current residence to then purchase that new residence as of June 30th. So we're basically just getting the financing difference that you need between the mortgage that you're approved for and what down payment you planned. So it's basically your down payment that you plan to put down from the sale of your existing residence.
And then the interest is just on that portion, right?
Correct, yeah.
How's that interest rate calculated? Is it like same as what your new mortgage is going to be? Is it a different rate? Is it?
Yeah, it's a very high rate, to be honest. It's because the loan itself is technically unsecured and it's on the assumption that your house is going to sell, it's going to sell firm, and it's going to close on that said date, and the bank is getting their money back. It does come at a premium, and it's upwards of just over 10%. However, yes, 10% sounds very bad. Bridge loans aren't meant to be for a long period of time. They're meant to be for a week, 2 weeks, sometimes up to a month or 2 tops. So for that reason, from the cost perspective, and because it's only on a smaller portion too, depending on what the down payment is going to be, it could be maybe a couple $1,000s max. But that couple $1,000s, in my opinion, sometimes for most families, it's well worth it because then you don't have to worry about struggling to close everything on the same day.
Mm-hmm. And I've even had lawyers recommend to stop doing that because it just turns into such a disaster if the money comes late or something, and then you have to do a closure in escrow if it's even possible, or you might have an entire weekend where you're in limbo.
Never close on a Friday.
Yeah.
Never close on a Friday. From experience with banks, never close on a Friday.
Yeah, always on the Thursday.
And any other day, except for Fridays and days before holidays.
Yeah, I've used bridge loans on pretty much every move that I've done. And I did use an extended one time. It was 5 weeks. And the reason was we were renovating the house before we moved in. So we got the keys. And then that night we went in and demoed it and then went to work on it. So that way it could be ready for us to move in, right? So that's even... And because I think a lot of people, they misunderstand that if they overlap the closings, that they're going to have to pay 2 mortgages, right? Which isn't true. And that's where the bridge becomes super effective.
Yes, exactly. So the bridge, basically, there is no payment unless you're doing an extended bridge, which I think from our guidelines is anywhere for more than 60 to 90 days, which honestly is not common anyways. Very, very rare from what we see. Only then is there an actual payment attached. So if it's anything shorter than that, it's just a one lump sum payment once your house sells. It's all done on the legal side. The lawyer signs what's called a promissory note, basically confirming with the bank saying that as soon as we get funds from the sale of this client's house, bridge loan is the first thing that gets paid out.
Perfect. Yeah, it's a cool tool. I always tell people you should be using it, right? But there is a price with it. So it all depends too on what your numbers are looking like, right?
It's worth it for flexibility.
Yeah.
And it definitely depends on the number. So that's why it's always best to kind of understand the situation beforehand, run through numbers on paper and just make sure it's right for you.
Yeah. When I did the last house, I didn't do it. It's the first time I never did a bridge loan. I closed on the same day on a property. And because the bridge loan was going to cost me like $3,500 or something just for the weekend. Because at that time, the rates were at the highest. Like I bought when the rates were the highest because I got the best price on the house that I bought. Because honestly, I never would have been able to buy the house unless the rates were so high. But I was looking at the fee. I think the bridge was like 16 or 17%. It was something insane. And so I was like, you know what? Plus I had to pay a fee of like $1,500 up front. I was like, I don't know. At the time, I just thought I'm going to do it. And I closed on a Thursday just because that's my experience, is never close on a weekend. I'm glad I did, because the people that closed on my house, the people that bought their house, it was so trickled down that the money for my house didn't come until 5 o'clock. And then there wasn't enough time to wire the money to the house I was purchasing. So they just did a closing and escrow, it's called. And then, the next day we closed, we were able to move in that night. And then the funds just transferred the next morning.
That was always a very interesting topic to me, is the topic of real estate when it comes to buying and selling. It's basically a chain link effect a lot of the time. Now, how long that chain is, nobody knows, but you're buying a house. Okay, well, what about the buyers that are buying yours? And then the buyers that potentially are buying theirs? And where does that link end? And if one chain in that link breaks, everyone after that is just, it's a messy situation. So it's always been a very interesting topic.
I've heard people, sometimes there's like 5 or 6 in the chain. Like, you're selling a house, the people that are buying yours, they're waiting for the money on their townhouse, who's waiting on the money from a condo, who's waiting on the money from like seniors that downsized from a house into the condo, that's waiting on another buyer on there, right? And it's like, by the time all that money comes, like if it's all happening on the same day, by the time that money comes to you, because of the money, like you would think now with everything, the banking system is just like instant.
It can be. I'll be honest. It can be. It depends on the preparation and to make sure that everything's done beforehand.
Yeah.
And well in advance. Because there's some experiences where even technology, where there's been technology issues where the funds get wired and nobody can find the funds and they're just kind of sitting in limbo. And what do we do? Well, a lot of the times the banks can't pull those funds back because they're sitting in limbo. You got to wait for the quote unquote system to reject it on the other bank's end or the receiving end to send it back. And a lot of the times the banks might not want to double fund just in case if they can't get it back. Like it's just, it can be a nightmare sometimes, but that's why being prepared.
And never close on a Friday.
And never close on Friday.
I like
Absolutely.
it.
Yeah.
So what else you guys got going on? Any other exciting programs?
Yeah, one of my favorite ones is what we call our net rental offset program. So this program is actually really guided towards those investor clients who not only just have one property and a second, but also a third, fourth, fifth, sixth. We use a common sense approach. And what that basically looks like is we look at each individual rental property as its own entity. And we take a look at, is the property cash flow positive? Is it negative? Do you break even? Kind of where on the spectrum are you there? So a hypothetical situation is sometimes you might go to either brokers, other banks, where a client might have 4 rental properties and they can't get approved because their debt servicing is just way through the roof. So what that is they compare the total amount of debts compared to your total amount of income. You get a percentage, and that's basically the be all end all of if you can get approved or not. So where we look at a common sense approach is we take a look at each property individually. Just say you have 4 different properties, 4 different rentals, and you're making money off all of them. You're in a profit of, call it a couple $100. So we'll basically pretend like that all those 4 properties are not even there. So now you're getting approved solely based off of the numbers on your current existing home and then that other rental you're buying, or whatever the situation is. So using a common sense approach to sometimes in cases, especially if you have an investment property that's cash flow positive by a big chunk, that can actually help you get approved for more on the flip side using this net rental offset program. So that's where we really thrive, is helping investors not only just get approved for that first property, but the second, third, fourth, fifth, and so on.
That's how they keep rolling with it, eh? And so essentially if it breaks even, you guys just don't even, pretend like it's not even there.
If it's cash flow negative, we ultimately reduce that negative from your total income, which could slightly reduce your purchasing power, but it's much better than the other banks the way they look at it, where they take all the income into consideration and all the debts and throw it into one formula, I guess you can say, because mortgage applications, it's all numbers based, it's all math. And we take a common sense approach. That's the best way I like to describe it is, what is your actual situation and how does this make sense on if you can afford that next property?
Yeah, that's a good way to look at it. Because even I know some banks only take like half the income.
Yeah,
I've
that's
heard
another
like
one.
50% or something.
50%, sometimes 60, up to 80 for the most part. We can go up to 90% depending on where the property is. So, but that's not even the biggest part of the program because we can actually use 100% of the income if it's a rental property and comparing it to all the debts and pretending like it's not even there. So that's the best part.
Do you guys finance student rentals?
No.
Okay. Almost nobody does. It's very difficult to get financing.
Yeah. Now, if you, I don't know if I should be saying this out loud. If it's not labeled as a student rental and you rent it out however you please, that's a whole different conversation.
Okay.
That's, I'll leave that for viewers to decide.
Yeah. Because even now with the changing, there's around Westdale and around Mohawk, it's changed already. Like by law, you gotta have a license now to have a rental there. And a neighbor of mine owns 2 student rentals down there. And so he's got, I think, 6 students in one house and they're all on one lease. And so when they came to do the inspections and stuff, they said, okay, well, everybody's on one lease. So they they basically said to him, like, you're fine because it's all on one lease. If you had separate leases for everybody, he said, then this would be considered a rooming house. So, I mean, I feel like the financing just gets so messy with those things.
Yeah, that situation would be very messy to begin with, solely because of now they're on the same lease. Now, how are they connected in any way? They're all friends. Okay, well, that just kind of screams red flags. On top of that, too, most of the times on leases, you might have maybe max 3 to 4 people. And sometimes even your kids are on there for whatever reason, but that's a whole different conversation. But then also another thing that we use to confirm the income is rental deposits. So how are those deposits coming in? Is the total, 6 people, $3,600 and we're getting 600, 600, 600 because that's more likely the case? Or is it all one e-transfer of 3,600? That's another thing that we would look at and kind of look at it as a red flag to say, okay, well, these people are all individuals.
That makes sense. Okay. And then say that you're like somebody that's not an investor that's scooping properties up. Is there any programs for people that say you want to buy a house that has income in the basement or something? You got a rental suite in the basement or a little duplex or something? Like, how does that work? Say that I just want to buy a house and, rent out my legal basement apartment.
Yeah. The key word is legal. It has to be legal. So normally when you're purchasing a property, and this is where you have to be very, very careful, and your realtor has to do their due diligence as well. A lot of realtors and listings will put legal duplex. However, they don't have a certificate, they don't have confirmation, they don't have city bylaw, they don't have any of that. So ultimately what we would be doing is, in order to confirm that income, we would be doing an appraisal on that property. Appraisal companies as well, they have access to all this information. They will be honest with us and tell us, is it a legal duplex or not? And that will decide what income we can use. But the short answer is yes, as long as it's a legal duplex, triplex, we can even go up to quadplex, which are very rare. We can use what we call market rent, whether it's already rented out or part of the appraisal will actually tell us. The appraiser will let us know how much each unit could rent for. Whether it's you're living up top and you want to rent the basement, that's generally what most people do. We can use that income from the basement without any hesitation, which is nice. Can help you get approved for more.
Okay. What about if you're getting some roommates? You want to buy a house and your friends want to rent some rooms off you?
Sadly, no. At that point, you can go joint. You can go joint and purchase the property together, but even then with friends, you got to be very careful. So, but sadly, no, that's student rental, I guess you can call it.
Yeah. Does owning properties with other people affect your financing when you're trying to get other stuff?
100%. So this is where we always err on the side of caution and have full, complete conversations. If clients come to us and say, hey, I want to purchase a property with a friend. It's not very, very often, but we've seen it a lot more nowadays because of the type of properties that are there and the qualifications. A lot of the times you need 2 incomes to qualify. So unless you have a spouse, significant other, and or family, direct family to co-sign, siblings to join in with you, it is becoming more common that people do purchase properties with their friends. However, now that's where a holistic conversation has to be had between both of the friends to make sure that everyone's on the same page when it comes to timelines, when they want to potentially sell. If one person gets in a relationship, how does that affect things? Because if you have that property and own it together and then one person branches off and tries to purchase a property on their own, they're fully liable for that current mortgage joint with the friend. So that could definitely significantly increase or decrease your purchasing power when you go to purchase something on your own.
I think that's a big thing. So just to clarify, say that the mortgage on that property that you own with your friend is like 500,000. You, when you're qualifying, that whole 500,000 is taken into consideration, not 250, the full amount.
100%, because you're getting approved on that 500 joint with someone else. So if something happens to one of the owners, you're fully liable for that mortgage. So that's the way that the institutions will take a look at that.
That's the biggest reason I've never done joint investments.
Yeah.
Is because if I'm going to take on 100% of the liability, I figure, you know what, I want 100% of the income. But some people look at it very differently. They'll want to pool money together because it's the only way to purchase a property, right? So
it's all about expectations when it comes to that, which can be tricky. It can be tricky.
Yeah.
I've seen situations before where exactly like that. All of a sudden, one of the owners got in a relationship and is like, hey, like it's time to sell. I need to move on. The other one was not willing, and there's nothing you can do about it, sadly. And that's why it's just be making sure that you guys are on the same page.
Yeah, especially when you purchase it and having sort of a plan in place. I had two friends purchase a house together, and then they ended up actually buying new construction, two semis that were attached to each other, like in new construction. They were just destined to live by each other. And but their plan was always, I guess maybe because they purchased the semis at the same time, the plan was like they were able to coordinate, okay, let's sell. Like now we need to sell this house so we can get our houses. But they always looked at it like, okay, this is an investment. And at some point, if one of us wants to sell, we'll either buy the other out or we'll sell the property at that point. They kind of set out from the start. But I could see how that gets tricky if you're like, oh, let's buy this house. And then all of a sudden you get in a relationship. And
exactly. Especially if it's owner occupied, it's a lot more difficult if they're living together, because then things change. If it's an investment property and it's going to be rented out for the long term, a little bit more easier to coordinate and be on the same page for. But when it's your primary residence and you're paying a good price, your mortgage is fairly low, and then all of a sudden your friend comes to you and says, oh, well, we got to sell, time to move out. It's a lot harder. Can be a lot harder.
If you're buying an investment property, say that you don't own a house and you want to buy something that's 2 units and you're not going to live in it. You want to rent it, but it's your first house. Can you get away with 5% down or no?
Technically, no. So because you're putting less than 20% down, anytime you're putting less than 20% down, a company called CMHC, Canadian Mortgage Housing Corporation, ultimately steps in, and they're actually the ones that will be all final approval. At that point, the bank has no say in the final approval. So whenever you're putting the less than 20%, you have to go through CMHC. As per their guidelines, government guidelines as well, the property does have to be owner occupied. So we can still use the rental income from the basement unit as part of that application. However, we have to phrase it as owner occupied. However, what you choose to do after the fact, sometimes we can't control. That's not me telling you to go rent out both the units, because that's well beyond my expertise, because it could become a potential legal issue and whatnot. But as per our guidelines and CMHC guidelines, I guess you can say, you technically have to owner occupy it.
Yeah. And it's definitely, I feel like, a situation you don't want to get tied up in on the negative end of that, right? Like, it's always good to just be honest, I find, if you're not like, because it's essentially it's mortgage fraud, right? If you're doing it,
100%, yeah.
And people, I know, like, that's a heavy word, but that's what it is.
In a way, yeah, you're lying on your application, but is mortgage fraud.
Yeah. Yeah, but you know what? It's good at least the tools are there in place. And CMHC, I mean, what do you, like, dealing with a lot of first-time buyers?
Yeah.
What are you seeing? Like, are you seeing a lot of 5% down, a lot of people hitting 20? Like, what are you tending to see these days?
A mix of both. So first-time home buyers, it definitely depends on income, life stage, savings. So sometimes a lot of the younger ones, unless they have family help, it's always less than 20%. It's hard nowadays, especially with the purchase prices now being upwards of 500-600, depending on the area too, to come up with 100,000, 120,000 when you're fresh out of school. You might be paying off some student debts and whatnot. It's very challenging to get up to that 20% without family help. So for the most part, we've seen a lot of less than 20% down. But as of the past, I think it was December, CMHC is really helping out, where now you're allowed to stretch your amortization to 30 years. Doesn't matter if it's new construction, if it's your first time home purchase, you can stretch the amortization to 30 years versus what was originally 25, making it a lot more affordable and somewhat easier to get approved.
No, that's a good point. People always say that you shouldn't take the long amortization. I would take a 50-year if I could. Like I would, because my intention always is I aggressively to pay down my mortgage, right? So it's a conscious decision every year, slap some more money down on it, right? So at the end of the day, if I get the lower monthly payment, but I mean, I guess the argument is to go shorter term anyways. I don't know, whatever suits you. But
well, that's why it's not just what is best overall, it's what's best for you. Your situation, what are your goals, what's your plans? Personally, especially for first-time home buyers, I always recommend take the 30-year amortization. The reason being is because cash flow is the one thing that you cannot control. If you take the 25-year, you're stuck at that payment. You can't go backwards unless you refinance, which you have to go through the whole process again, qualification, fees, and all that fun stuff. But the best part is if you start at the 30-year, you can always spring ahead and pay more and get to that 20-year mark. You can always jump forward, but you can't jump backwards. So you're better off taking the 30-year, making sure your cash flow is key, and making sure that you're on par with your budget before going to that 25-year mark.
Because the mortgages can be structured that people can make direct principal payments every, like how would that work? Like say, could somebody pay extra per month directly towards the principal? Could they pay monthly sum? Do you guys have a specific limit on that? Or
lots of flexibility, which is massive. So we have a rule which is called the 20-20 rule. So the first 20 is you can increase your mortgage payments by 20% of your existing mortgage payment per calendar year. Hypothetically speaking, just say your mortgage is an even $2,000. You come to me a week after you close and say, hey, you know what? $2,000 is cheap. I want to increase my payment by 20%. You can jump up your payment to $2,400. Ultimately, that extra $400 will be going directly towards principal, which will ultimately reduce the amount of interest you pay over a long period of time. It will reduce your amortization or life of the mortgage, and we can use that strategy to pay down quicker. The other 20% is the one I personally prefer. You can actually make lump sum payments of 20% of your original mortgage amount per calendar year, minimum $100 installments. So what that looks like is, call it a $500,000 mortgage. You can prepay up to $100,000 per calendar year without paying any penalties. You can do, $1,000 today. You can do $100 next week. You can do a lump sum of $50,000 at the end of the year. Whatever works for you, you have that option. I prefer this option solely because then, like mentioned before, cash flow nowadays is king. You want to make sure that your budget is on par. So accumulate those savings, accumulate those few $1,000s, and throw it in when you're ready. Maybe at the end of the year, beginning of the year, halfway through, whatever suits you.
Mm-hmm. Yeah, and cash flow is everything. It's like you said, it's better to have the option to be able to pay more, that's a great defense to take the 30-year rate, is because you know that you at least your payment will be lower should you run into a situation that the cash flow is tight. But as you start to, whether you make more income, life changes, or you realize you can pay more, then you just start paying more directly towards your principal. The question with the 20% on, like, say it was $500,000. Say you did a 5-year fixed, renewal comes up, whatever your renewal, you're in like year 7 or 8 or 9. Is it still the total original amount? You can do up to 20% at original 500, even if at your renewal you're down to like 450. Like you can.
Correct.
Wow.
It's based on the original mortgage amount of when you sign the paper. So it's always going to be, in that case, that $100,000 per calendar year throughout the whole life of the mortgage.
And that's with BMO, right? It's not like not like you had a bank and like you were with somebody else for 5 years and then you switched.
Exactly. So it's based on what your mortgage amount was with us when you first started. So even if like you refinance down the road, hypothetically, at that point, you might need a $600K mortgage due to, debts, renovations, anything like that. Now that 20% will reset, but now it's $120,000, which is 20% of 600 versus the original 100,000. So it's always based off of your original mortgage amount.
Mm-hmm. That's good. Good to know.
A lot of flexibility, which is nice.
Yeah. Flexibility is great when it comes to mortgages. Especially if you want to pay it down. Like, paying off your mortgage is the dream.
It's
right?
nice. Oh yeah. It's the Canadian dream, but very rare nowadays to see a mortgage paid off.
It is. I have a friend that just did it, 36 years old, bought a house. Yeah. What did he buy in like 2014? So this is before even the first crazy market. Then he picked up a house and he's lived in it, and he met a girl and she owned a condo. They got married. She sold her condo, put the money down to pay off the remaining balance of his house because his income, I guess, went up and he was making extra mortgage payments. And yeah, so it ended up, they paid it off and like 36 mortgage free. Like it's crazy, right? But you know what? I'll tell you this though, the house was not renovated. It was an old 2-bedroom bungalow on one of the east streets. He built a garage. They just did the kitchen, but they did the floors. Like that's the thing is he went the route of buying something that like so many buyers I find nowadays, they want either the house that they grew up in, which like a beautiful 2-story family home, or B, they want something that's all like new with like the paneling on the wall. Like they want it to be Instagram, you know, friendly or fancy and all that. They're not willing to move in and live in something older for the time being. So
People's standards are high.
yeah, he just did it, right? But he was a single guy, so he didn't really, I guess he didn't care as much.
Of course, yeah. Yeah, and now look at him, 36, no mortgage, endless possibilities. Think about all the savings and the investment, preparing for retirement. He's got a lot of options, which is nice.
He's got me every week telling him to buy a bigger house.
There.
You get a little mortgage, come on. Keep the juices flowing, right? I love it. So is there any other programs you guys got running on right now? Those are the main 3.
Yeah, those are the main 3. I mean, the whole first-time home buyers, no specific programs, but if you are a first-time home buyer, and I can't stress this enough, start planning. Even if it's just a conversation of where you're currently at, where you want to get to, what options that you may or may not have. And the biggest one, open up an FHSA, a first home savings account. You will get a fantastic tax benefit when it comes to tax season. You'll get probably a few $1,000s back from the government, which will always be nice. There's no kick to it. You'll be able to withdraw that amount when when you do purchase your first home. So if you're saving for that home and you have those funds, open that account ASAP.
That's a huge one. It's overlooked too, right? It's newer. Some people don't even know about it. I've done a few first-time homebuyer webinars, and people are always, I don't know, especially new Canadians. They don't know anything about this stuff, right? So, I mean, getting it out there is huge.
And the best part is it differs significantly from the RSP. So the whole idea of the FHSA is to help first-time home buyers be able to get some tax benefits, get more savings to purchase their home. Now, the difference between the FHSA and the RSP is the RSP, if you withdraw for your first time, which you perfectly, no issues, you have to pay it back over a 15-year period. So if you're withdrawing, just say you have $40,000, $45,000, call it, in an RSP, and you withdraw that, every year you're going to have to put $3,000 back into your RSP. As for the FHSA, you withdraw it all, the account's gone, you don't have to worry about it again. So you're getting the same tax benefits as the RSP. However, you don't have to pay it back, which is the best part. Another key piece too, and this is where any first-time home buyer, short-term, long-term, there's no holding period in the FHSA. So what that means is with the RSP, technically the funds have to be in the RSP for 90 days before you can withdraw it as part of your first-time home buyer's plan. There is no such thing with the FHSA. So if you are buying a home or in the process right now, you can technically open the account, contribute $8,000, get that tax receipt, and the next week withdraw it. First-time home, no issue. So it's fantastic.
That's huge. And that's where even, like I always tell people, they think it's too early to talk to somebody at the bank, right? They always think, oh, it's too early, I'm not ready to buy it. But they don't realize, like, you should, if you're planning, even a year in advance, you know, go and talk to somebody to come up with a plan to get you there faster and more efficiently in a way that'll benefit you, right?
So the good thing about mortgage applications is the way I operate specifically is I'll do a pre-approval. So what that means is without jumping into documents, just understanding your life situation when it comes to income, debts, goals, what types of properties you're looking at, we could actually just run through numbers on paper and get you a very, very precise amount of how much you could be pre-approved for. That's without jumping into a credit check, without having to send me all income documents. But then of course, the next step would be then the pre-approval where we jump into a credit pull to make sure that basically they're not lying to me. But even the pre-approval is the best way to start because it's just numbers based. We run through everything on paper and we get you a pretty precise number at the top of your head, just so then you have that information available to you.
That's awesome. Awesome. I love it. Well, I love all these programs. I love what you guys are doing. I got some last minute questions for you that I always ask everybody that comes on this podcast. So you got to be prepped. Well, what are some of your favorite parts of the job?
Especially being a younger individual, starting out a family, starting out life, is the flexibility. the flexibility of not working a 9 to 5, not being in an office 9 to 5 tied down, being able to work really whenever, sometimes wherever I want. That's my favorite aspect. From my own personal point of view, the other is definitely being part of someone's home buying process. I've seen situations, and part of my family have been in situations where I don't want to say they got screwed over, but the process didn't go as clean as it should have been. And that's where the education piece of I want to be able to help people go through the process as smooth as possible. Where you get all the time too, where buyers, you're not purchasing a property and closing next week. Normally a month plus out of the way. Let's get everything done in that condition of financing period. Those 5 days that we're getting to get everything done, let's finalize it. Let's get everything done, all the conditions satisfied, so you can just sit back and wait until you're closing. Let's not wait till the last minute. Let's make sure that funding goes smooth. Let's not do closings on Fridays. Let's just make sure that everything is as smooth as possible. And that's my, I guess, second favorite part about being in this position.
That's awesome. And that's a great benefit of being with a bank too. Like, when you said some people had some not so great experiences, I find a lot of it, like the barrier, from my understanding, I may be wrong about this, barrier entry for somebody to just become a mortgage broker, right? Like for a random company, it's not that huge. Like same like real estate, it's not a huge barrier to entry. And you end up getting people to get in that are greedy, trying to make a quick buck. They don't care. And
they're not knowledgeable, no experience. And you probably heard the phrase, I'm sure all the listeners are going to agree as well, is all banks are the same. They truly are. All banks will offer similar promotions. They'll offer similar rates, same accounts. If you literally look up accounts from each bank, they're the exact same, except they're just called something differently. In my opinion, though, it's who you get at that said institution that can make a big difference. Knowledge is power, and you need to be able to work with someone who knows what they're doing. And I'll be honest, in a position like mine, there is turnover. There's people that don't do well. It was not what they expected. They haven't really dealt with mortgages and mortgage financing. They jumped into a role thinking it was going to be all rainbows and butterflies, and it's not. And you might get someone that's inexperienced. So you want to make sure that you are working with someone who knows what they are doing.
Mm-hmm. It's well said. I like it. What would you say is some of the challenges? Like what's a challenge that you find with your business?
The business portion itself is the competition and the way clients have that access to knowledge. It's funny because a lot of people, in the biggest topic right now is rates. Rates this, rates that. Sometimes it's not, I'll be honest, it's not always about the rates. I'm sure you've probably seen the Quest Trade commercials about investments, where it's like, oh, fees this, fees that. And then of course, other institutions are coming out saying, well, it's not all about the fees. If one person can get you a return of 10% and charge you 2% fees, but then the other can get you a return of 5%, but only charge you 1% fees, that's a difference of 8% return versus 4% return. So that's not the full picture. But ultimately, the access to the knowledge and the access to rates, for example, it doesn't always show what the actual situation is. And the perfect example is a lot of these companies, they're marketing rates as default insured rates. So it always says, oh, we can offer you 3.99. However, there's a little star that says default insured purchase only. So people look at that and say, oh, I can get 3.99 easily. Well, it's like, no, default insured is only your first time home buyers, a new purchase, and you're putting less than 20% down. So it's a very niche specific market that they can get that rate. So right now, it's the biggest challenge is the competition when it comes to the rates. And people giving pushback and kind of not understanding the process as a whole, I guess you could say.
Yeah, I could see that. The people get so focused on the actual number, not necessarily the terms of the mortgage, the flexibility with the mortgage, what's going to suit their plans with it, right? Like I always did variable in the past because I was always very mobile. Like every couple of years I was moving, so I didn't want to be locked into a 5-year, right? And I was aware that the penalty on the 5 years is a lot larger than it is to break a variable, right? So, I mean, for me, and it's just having that knowledge, like, okay, I might be paying a bit more, but it's going to save me in the long run when I want to do this, or I just have this flexibility, right? So, I mean, I think the rates, obviously getting a good rate is good. It's not a bad thing. Yeah. But you also have to take into consideration the terms,
100%. There's a lot more details. And then also approval amounts. Sometimes, we might have a program that brokers can't offer. So we can get you approved for more. However, a broker can, or someone else can only get you approved for, X amount. So It's a full holistic conversation and the full financial picture that we want to look at.
That's awesome. And then lastly, if you had to go back and tell yourself when you were first starting this journey, if you had to give yourself a piece of advice, what do you think that would be?
Two things. I want to add a second. First, don't go to university. Don't work and pay for your own school and get a degree in kinesiology. That's definitely the first thing. Jump into the force right away. But honestly, connect with a lot more people. Where when I first started, I was just kind of sheltered to myself. I wanted to make that career move and get that salary and go from there. But now being in a commission role it's all about connections and putting yourself out there, calling, picking up the phone, talking to anyone, asking questions. You never know what you're going to get. There's situations where, you're at a family barbecue and then all of a sudden a neighbor comes by. Oh, he's a realtor. Perfect. Here's my card. Let's talk. It's just connect.
Yeah, that's huge. And I find especially I know when I first started out, and I don't know about you, but a lot of people when they're in these roles, like these commission roles, these sales roles, you're shy to tell people that you're doing something because you don't want to come off as being like, oh, I'm just yeah, I'm a real estate agent. I feel like some people are like, oh, that's kind of greasy. Yeah.
Yeah.
They feel like I felt like at the start, I didn't want people to feel obligated or I was going to pitch them pushy. Yeah. Right. Whereas now, I'll tell everybody, shamelessly promote because I don't care anymore. This is what I do. Right.
It's just being available to is, hey, here's my information. If you have any questions, let me know. I want to be able to provide you. And the biggest key phrase I like to use too for my own business is I want to be a second opinion. You can go and be with someone else and work with someone else. However, get a second opinion. It's free. I want to be able to take 5, 10, 15 minutes out of my day to make sure that you are getting the right choice and the right terms and the right price and the right rate and all that fun stuff. So
that's huge.
Being a second opinion.
I love it. That was good. This is awesome. This is a lot of fun. Time flew by on this.
Oh, absolutely.
I love talking about this stuff. Hopefully people like listening because it was super informative. You just touched on so many great things there. But thanks again for taking the time out of your day to come in and do this. Truly appreciate it.
Thank you for having me.
Absolutely. Everybody else, thank you for tuning in. We will see you again on the next episode.